shelter and minimize your tax liabilities. What are some of the common ways with crypto that your clients or otherwise have been able to shelter, minimize tax stuff, things like that?
Well, there's several ways, and it really all depends on the goals, on the financial goals of some people. I can tell you that you can shelter capital gains through certain kinds of trust, but some of that will not give you access to liquidity, right? And that's not going to work for some people that would like to utilize funds in the immediate future. And then there is other type of shelters that you can use to fully invest in the stock market. And you can shelter that money from capital gains and then just shelter it over to a vehicle that will allow you to fully have a stock portfolio, but that's it, right? And then you're not going to be able to do anything else but that. And there's some other stuff that will allow you to have a lot of flexibility and freedom, but will have other restrictions, right? So there's always a way to avoid capital gains, and there's tons of different vehicles that you can use. However, it all depends on the profile of the investor. So my profile of me as an investor, right? Because every single person is going to be different. Me as a real estate investor, I like to grab my crypto gains. And as I grab my crypto gains, I go ahead and use those funds to then put it into real estate. So then how do I offset my capital gains? Well, I do cost segregation studies and I do all these different things. And therefore, I create all these different losses in my Schedule E. And I use those losses against all the capital gains that I make. So in that way, my investor profile has now achieved a few things. I have increased my cash flow from an appreciating asset such as HEX or Pulse or PulseX, whatever you want to call it. Because I distinguish basically assets in two different categories: cash flow and appreciating assets. And sometimes they're both. HEX, PulseX, and PulseChain, they're all appreciating assets. And even though we get a yield on HEX, it's really not a cash flow asset, because I have tried to do my staking ladders, and the price valuation really kind of messes the cash flow of things. And look, when we're in a bull and we're making a lot of money also on the upside, the staking ladders, you would need a big amount of money to be able to kind of create that sort of cash flow that will serve you to substantiate a lifestyle. So I have categorized HEX and PulseX and PulseChain as appreciating assets. Real estate, on the other hand, is an appreciating asset, obviously not as much as a crypto asset. But it also, as far as a certain profile, you can go ahead and create cash flow with real estate. So from those capital gains that I create on an appreciating asset, I go ahead and also transfer it to other assets that might be a little more steady on the cash flow. So then I can use that cash flow to put back into crypto if I want to, or to substantiate and elevate the type of lifestyle that I want. And in that place, now I have increased cash flow. I still have my capital in an appreciating asset, and I have reduced my tax liability to zero, because now I don't pay any money on the cash flow that I get on real estate with a cost segregation study. I create losses, and therefore those losses are going to go against the capital gains that I have here. Now, but that strategy only works for me because I like real estate, and I like to be active on the real estate that I have, right? Someone that doesn't have the funds to buy real estate, or someone that doesn't like real estate or doesn't want to even get involved, they need to look into something different. They need to look into charitable LLCs. They may want to look into GRATs, or they may want to be looking into DSTs, which is a deferred sales trust. And all these different strategies are going to be different to each individual. But one thing that I can tell you, which is basic, is even though that harvesting losses with wash sale has now been eliminated as of 2022 in January, what we used to do is that every time that the crypto market would go down, we would sell our positions to accumulate losses, and then we would rebuy our positions. So then we can go ahead and ride it on the way up. But we have now harvested all these different losses throughout the whole year to go against the capital gain at the end of the year. That was called, like, for example, in the stock market in traditional market. That's called wash sale.
Yeah.
On wash sale, it's eliminated or disallowed if you rebuy your position within a period of 30 days. So that means that those losses of you selling your position at a loss and rebuying your position, those losses would be completely disallowed. However, since crypto is not a security and we do not fall under security law, we were able to just, boom, harvest all these different losses. And then whenever we had a large capital gain, it would be just against that. As of January 2022, that got eliminated with wash sale, but it was left in there that those losses would now be added into the cost basis. So if you have an asset of $100, you lose $50, and then you sell your position, and then you see the position go up to $150. That means that your original cost basis of $100 plus the $50 loss that you had in there is now a cost basis of $150. And since you sold it at $150, now your capital gain is zero. So a basic strategy for us to continue to have is to actually record the losses of the transactions that we have. Now, that might have a negative effect on certain positions as well, due to the fact that they're not going to be long-term anymore. So you have to be very careful and plan how you're going to go ahead and track the cost basis of certain assets. If you don't want to mess yourself up or shoot yourself in the foot by saying that that you are harvesting long-term capital positions, and then suddenly just because you're doing loss harvesting, you're going to then convert all those positions into short-term positions. And if you miscalculate and then you have gains, now you're going to get taxed as regular income instead of the preferred tax rate of capital gains, which is 15% or 20%, depending on your tax bracket. So, but that's a basic one.
Okay. And are there certain strategies that, maybe clients come to you and say, oh, I really want to do this, and it sounds intuitive, it looks okay, but then when you get into it, you're like, no, that's not a good idea? Are there certain interesting ones people should look out for that look too good to be true, I guess?
Yeah. Well, I mean, I can give you a very specific case. And my friend, he was looking into renouncing his I don't know if I should. He was looking into renouncing his green card and cashing out all these different things by applying for his Dubai's. It's not a citizenship, but it's a special status in Dubai where you create a corporation and then you have this special election for you to trade in Dubai, and all the capital gains taxes that you have in there is completely tax-free.
Okay.
And he was doing the transition to do Dubai move since he has a preferred treatment, but he has to give up his green card. So in the middle of it, while we were talking to attorneys that would take care of all these things for him, they said, well, you're not going to be able to come back to the US unless you apply for a tourist visa. And he had to really think about it. He's like, I don't really have any family here, but I like the lifestyle here in the United States. And even though my increased bracket of taxes is going to be up to here, creating a life here is going to be better than creating a life in Dubai for him specifically. Now, obviously, for someone else, you might be adventurous and might be like, nah, I want to go over there. I want to go jump from Malta to Cayman Islands to Dubai. And I just want to live over there in that area. Good for you, But there's always negative there's always negative things. A deferred sales trust, for example, has a beautiful positive thing to it, but there's also a negative thing about it. So, for example, a deferred sales trust, what it does is that you sell $1 million in HEX right now, and you want to avoid capital gains. So, therefore, what you do, you transfer that money out into the deferred sales trust, and you have basically, you transfer the asset before you do the sale, and then you have the trust do the sale of the asset so you can record the sale within the DST. And now that the transaction has been recorded under the deferred sales trust, it didn't capture any capital gains. Now you have tax-free money. But then the problem becomes, well, how do I take it out? And what can I do to actually use it? So one of the things, it restricts you to actually purchase only other assets. which is fine sometimes. Maybe you want to buy another crypto asset or something like that, or real estate. Maybe you could. Well, one of the things is that you are required to have an annual distribution in which it's considered income. And then you're taxed on that, which is fine. I didn't get taxed on the $1 million, and I get taxed on maybe $20,000 a year or $100,000 a year. That's fine. The tax bracket is a lot lower, and I can take it. The negative thing about it is that you're not. Yeah. The negative thing is that you're not the owner of it. You need to have an attorney be the administrator of that trust. So you need to have someone that you're really going to trust, because everything's on the name of the attorney that you just hired. So you need to be very careful on who you're going to trust, who is your attorney that is going to do all these different documentation to make sure it's formed correctly. So there is all these beautiful things that people will pitch at you. Oh, this trust and these type of trust. There's 100 type of different trusts that they promise you to avoid capital gains, or that they promise you to do a lot of these tax savings. But if they're not done properly, and if you don't do certain procedures that are in place, and you don't have the proper documentation, instead of being a positive aspect, there's going to be a negative aspect and create a lot of painful headaches in your life, because now you got to deal with all of that, for you. I'm not saying run away from them. I'm just saying that all strategies are going to have a positive aspect and a negative aspect, and you should ask whoever you're dealing with about what those are, and they should be very knowledgeable about those aspects in the tax strategy.